Good afternoon, everyone. I'm going to get us started. I know people are still kind of trickling in, but we might want to get started sooner rather than later, so we're not running too late today. So thank you so much, everyone, for joining and for coming in. We're going to get started because we're already everything's running a little bit behind. We're just going to keep things moving. So I'm Heather Bromfield with Enterprise Community Partners, this is our Ask Me Anything session. So you get to ask your questions to representatives of 3 CDFIs. Does anyone in the room need interpretation? ¿Alguien necesita interpretación? Okay. I think we're, if anyone sees anyone who seems like they need interpretation, or just let us know. And Myra, is that your, sorry, in the back can help them out. Okay. So our intention with this panel is to demystify lending and to break down some of the key concepts that come up in the process of requesting loans. Our hope is that after this session, folks in this room know more about how to get these financing resources that are so critical for doing the work of stabilizing communities, decommodifying real estate, and ensuring that community members have permanent, stable, and healthy homes, and affordable, obviously. So just to give you a roadmap of what the session looks like, this isn't Ask Me Anything. Instead of doing a bunch of different presentations and then a Q&A, we're going to let your questions guide most of the conversation and then have responses from our CDFI representatives. CDFI is Community Development Financial Institution, so mission-driven lenders. But we couldn't pass up the opportunity to do at least a little bit of presenting and sharing of definitions and explaining of concepts. So our hope is that this will help provide a shared foundation of understanding to actually help, and that it will help anticipate some of the questions that some might have. And then flagging also that this session is going to be most relevant for CLTs who are in maybe their acquisition stages. It's a little less focused on the lending products available for transitions to community ownerships through LEHCs, is my understanding. I'd also like to acknowledge that, although she's not here today, Elizabeth Wampler from Lisk Bay area was a thought partner in creating this panel. So just much gratitude goes out to her for all of her time and thought in making this possible. I know we did this in the big room, so sorry to do this again, but want to get a sense of who is in our audience in this room. So before we dive in, who is a CLT staff member in this room? Okay, just a couple. CLT board members. Okay, CLT residents. Okay, striking out. Technical assistance providers or consultants. Okay, we got a few. Other CDFIs. Quite a few, okay. Funders. Great. CDC staff or traditional affordable housing developers. I know we have at least one journalist. Everybody else? All right. Okay. Well, thank you. That helps us get a sense of who we're talking to. Okay. We have our panelists here today, and we encourage you to briefly let you know who we're speaking with, and then at the later, after I run through this quick presentation, all of them will introduce themselves in more depth in their organizations and explain kind of where they do their lending. So Shellon Fraser is our Senior Director of Lending and Investments at the National Housing Trust. Tom Simone is the President and CEO of Genesis LA. Eve Goldstein-Siegel is our Senior Loan Officer at Enterprise Community Loan Fund, and I'm Heather Bromfield again with Enterprise as well. Okay, so we are going to start with, this is a basic capital stack. It's a hypothetical for 15-unit property. We're seeing that this is the total costs associated with this property are about $8 million. And what the stack is showing you is the 3 different components of their financing, right? So starting with a hard debt. So this would be, for example, a loan from a bank, a loan from a CDFI, or possibly even from a foundation. Loans from foundations or philanthropic sources are referred to as program-related investments, or PRIs. So just two key things to note about hard debt, and this may be really rudimentary for some of you. Hopefully it just kind of, again, sets the foundation, and we can ask some of the more advanced questions after this, but just to get everyone on kind of the same page. So two things to know about hard debt are that these loans are going to need to be repaid on a fixed schedule, and that interest rates will fluctuate according to the market. And again, all of our organizations on this panel today represent CDFI. So when they are talking about their own lending, they're talking about hard debt. Sorry, just setting a timer here real quick. Okay. And then next in this stack, we have soft debt. So examples of these are loans from maybe a city or from a county or from the state. This is also referred to as public subsidy. While it can come from different kinds of government, most often these days, it's going to be coming from local governments just because of availability. Although this funding is structured as a loan, the interest rates are typically much lower than hard debt, and the repayment terms are often more flexible than hard debt. So, for example, the loans may only be repaid if there's additional cash after all other costs have been accounted for. Sometimes if the loan is not fully paid off at the end of the term, it is forgiven. It depends on the priorities of the public agency that's lending. And then last, we have equity. So examples of this could be if a CLT has received a grant that they want to apply towards a project, or that they can apply towards a project. Can be their, just own their own cash they have on hand. And if anyone is coming from understands, tax credit affordable housing development, this would also be where tax credit equity comes in. Or it could be money that an investor puts into a project in general. It may not get repaid, or it will only get repaid if the property is able to pay back all the other debts on the property and has extra cash afterwards. So these are basically the three categories of funding and financing. It's a little bit of a simplification. And I'm going to avoid getting much deeper into the weeds on this than this. But the hope is that these slides might be a helpful resource that you can look at the conference proceedings or share with other people in your organization going forward. I'm just going to briefly talk about development phases, only to give an understanding of what lenders want to see when they are considering a loan. So the first, when you have a potential property in mind that you are looking to purchase and convert to affordable housing, and as you're preparing to apply for the funding, you're thinking not just about the first couple of years, but also how this property will operate in the long term. So starting with the acquisition period, where you're concerned about how much it costs to acquire the building and the initial rehab costs. The project stabilization period, where you're probably doing some rehab to the building. Maybe you're figuring out how, if tenants need to be relocated during that time. You're filling any vacant units in the property. Basically, there just might be some things that are in flux that don't reflect what the long-term operations will look like. And then last, you have the long-term operations period. So this is when you're gradually paying back your loans through your income from rents, and building property reserves so that you have enough money on hand to cover rehab costs in the future. The important takeaway from all of this is basically lenders want to see that you have a financial plan in place for all of these time periods. So the first two phases are generally covered in the development budget. So that's your point in time information about, again, the purchase price and the rehab costs. And then afterwards, an operating pro forma, which has, 10, maybe 10 years or more of planning with assumptions on what operating costs will be and what your operating income for the property will be. So basically, in this operating pro forma, lenders want to see that you can pay back that loan over time. They want to know things like, what are you contributing to operating reserves to make sure that you can fund future maintenance needs? What are debt payments going to be, and is there enough income to cover it? So, excuse me 1 second. All right, so as I mentioned a couple slides ago, there's some key differences between different types of debt. There's also some key differences between the types of lenders who give out different types of loans. Banks, for example, are mostly, their primary concern is making sure that projects will pay back their loans. They might not have as much consideration for the mission, kind of depends on the bank, but I think generally speaking, probably like our least of the different types of lenders that are concerned with mission. CDFI staff, so again, community development financial institution staff and foundation staff are also concerned with whether their borrowers can pay back loans, but they have additional concerns about the mission. They may be willing to support properties that look a little bit more innovative or unusual or different types of ownership models, and then what traditional banks might be interested in. And then public sector staff, again, also lenders, they're often the least concerned about the loans being paid back and making sure that they recoup all of the value of that, although some of them are, want to see so their loans revolve. But they're very concerned with ensuring that the properties can pay back the hard debt to other lenders. And they're also very concerned about making sure that the properties are financially stable and the quality of housing that's being provided is up to standard. They may have additional public policy priorities that they want to achieve for lending. So for example, ensuring that there's extremely low income housing opportunities that's being created, extremely low income for AMI, for those who are familiar, and then ensuring that community spaces and properties ensuring that there are community spaces for properties that they're lending to, for example, or for another example, supporting emerging developers in their area. There are many other public policy priorities that they may want to achieve, but this is just to give some samples. I've only got a couple more slides and I'll hand it, I'll be handing it off, but I'm just going to talk a little bit about loan sizing. In other words, how do you and lenders know how much of a loan a property can afford? So we're going to walk through some of the lines in an operating pro forma to figure this out. So starting with your effective gross rent, this is your annual income from all of the homes that are in the property, and then accounting for a share of units that are likely to remain, just be vacant at various points in time. From this value, from your effective gross rent, you deduct your operating expenses. So that includes things like property management, insurance, routine upkeep, utilities. Once you take out some money for reserves in this reserve deposits line, you end up with your net operating income. And this is the kind of like the important number to look at for loan sizing. Properties that have 0 or negative net operating income after you do all this math, or if they have a very, very small net operating income, are not going to be eligible for loans. So because the property cannot support this loan, the property can't pay back that loan, right? And I think we just have a couple lines here that just reinforce that, right? So in cases where you do have very, very small net operating income or NOI or negative NOI or 0 NOI, these are cases where what your property is going to need is a grant, not a loan. This last piece here is cash flow. So this just refers to what happens after you take out all of the different debt payments that you're making. That's what's left over at the end, right? Okay, I know I'm breezing through this. This is your crash course in affordable housing finance. We can definitely happen to answer more questions as we go on. But just to briefly talk about some of the things that lenders look at. Like, these are what they want to be checking before they do any lending. And I'm not going to talk about everything on this slide in detail, but more to describe conceptually. The two metrics. So one of them is a loan to value ratio, typically expressed as a %. And what it functionally does is helps lenders see if they had to take back the property because, heaven forbid, payments are not being made, would they be able to recoup the money through reselling this property? So historically, if the affordable housing industry wanted to see something around the ballpark of 80%, this can be different for affordable housing preservation. The second key metric here is the debt service coverage ratio. It's abbreviated either DSCR, DCR, all mean the same thing. It means basically how burdened the property would be by debt and how likely it would be able to repay its loan if some of the operating assumptions change. So for example, what happens if insurance rates spike? Is there any cushion to account for that? And so it's expressed as a decimal, and the typical minimum for that is about 1.15. We'll probably end up talking a little bit about when each of these is most relevant and what kind of flexibility lenders have when they're looking at these. So with all of that, thank you for sitting through this crash course that you didn't even know you were going to get. Hopefully this helps frame up some of the upcoming conversation. And we're going to transition now to first introductions from all of our panelists. And then I'm going to ask if anyone has any clarifying questions about the content in this presentation, that they just hold them until we get to the actual Ask Me Anything part. All right, I'll pass it to Eve.
Good afternoon, buenas tardes. As Heather mentioned, I'm Eve Goldstein-Siegel. I'm a senior loan officer at Enterprise Community Loan Fund, where I provide debt financing to affordable housing developers and community development practitioners. I've been there for about 6 years now and been doing community development finance for nearly 15. Before coming to Enterprise, I was at the Federal Home Loan Bank of San Francisco, working on their affordable housing program. And then before that, at another CDFI, managing some large acquisition funds. I'm happy to be here. I should mention, Enterprise is a national CDFI. I work mostly in Northern California, but we can lend anywhere in California or in the United States. So that's mostly what we do. Yeah, hopefully be able to demystify some of your lending questions here.
Hello, everyone. I'm Shellon Fraser, Senior Director of Lending and Investment at the National Housing Trust. We are headquartered in Washington, D.C., but are a national CDFI. So we lend throughout the country. We lend for both rental and homeownership projects, and have done quite a bit of work nationally with CLTs and other shared equity types of models. I'm happy to be here. It's always great to get to come to California and interact with. I feel like California always has a lot happening, and I get really excited every time I'm in the room with people from California. It's always talks of SB this and I don't know, it's lots of bills that are always being passed. And there's no place else where I can hear about all the great bills and how it impacts our lending, because the state is so huge. But happy to be here and hope that I can contribute to demystifying and adding what it is NHT does, and why is there a baby national CDFI in the room talking to you about your projects.
Hi, everyone. My name's Tom D. Simone. I'm the CEO at Genesis LA. We are a CDFI that primarily serves Los Angeles County with a range of community development finance for affordable housing, nonprofits, and economic development projects. I've been with the organization for 17 years and started as a loan officer. And we, yeah, I guess that's everything.
Yeah. All right, thanks so much, everyone. Okay, so I'm going to kick it off with just 3 quick questions before handing it to the audience. The first one being, and maybe I'll just start with Tom and work my way down. So if a potential borrower wants to approach you like as a CDFI for a loan, what should their first step be?
Sure, I mean, you'll get different answers from different people. There are a few first steps, but one that I would try to focus on is really scrutinizing all of the assumptions in your pro forma. That's really what underwriting is. We're kind of testing every single line, like, do the rents match the leases? What is the vacancy rate historically for this property or in the neighborhood? What are the operating expenses? And oftentimes CLTs are working with preservation projects. There's real data you can pull from if you can get that from the party that you're buying the property from. If you're doing new construction, there's a lot of similar developments that you could look to. And just data, you can ask the trash company what it costs to pick up a dumpster every week. And so really scrutinizing that, because that gets to what was shared up here about NOI, right? And that's where you start to run into differences between lenders and borrowers sometimes is what is the real NOI to now be applying your loan terms to size your financing. So I would recommend really digging into that thoroughly, and feel free to ask lenders. Like, you can be open. I know at least all of these lenders up here are open to phone calls and Zoom calls to talk through this and to really try to help you vet these numbers. And it can be an iterative and collaborative process.
This might sound funny, but for me, it is, do you actually want debt? I've had folks come to me who come and they say, I actually just want free money. And unfortunately, that's usually not what we have. So you've got to be ready for a serious conversation around hard debt, which is what CDFIs offer. The other thing, we are oftentimes bridge lenders, so we are lending for a short period and not for a 20, 30-year mortgage. So have you thought through that there's like 2 or 3 stops along the way? It is us first, but there's someone else that has to repay us, and that's longer term debt. Is that something that you're willing to go through twice?
Thanks all. So this is a related question for sure, but is there anything that you wish that people did or asked you before they even approach you for a loan? I guess this gets to kind of some of the relationship building, like how do you like to build relationships with potential borrowers? Maybe I'll start with Shellon.
Sure. So we usually say it's always a conversation. So come to us when you're thinking about acquiring something, you're thinking about rehabbing something, you're in the fairly early stages and you want debt. So come to us and talk about, here's what I'm thinking, here's what the project looks like. Do you think it makes sense? So we find ourselves oftentimes being TA providers a little bit. It is not what I do or what my team does, but more and more there's a growing need to provide like some context and ask you some questions that helps you to really be channeling your energy in the right direction if you're trying to develop. So come to us and let us know what those things are that you're thinking through when you know you want to acquire and want debt.
I just echo Shellon's comment. I think oftentimes about the debt versus grant funding or subsidy, we know that oftentimes some of the projects that CLTs are looking at, they can't really handle too much debt, but knowing that when you're approaching a CDFI, we rarely have grant money to give out. So so we can help you talk about, your pro forma. We can look at it, and I would say it is good to start that conversation early, but there's not a lot of flexibility around, we're going to give you a loan, and that's what we can provide to you. So thinking about early on, like, can this property, the best money is free money, absolutely. So I would maybe say start there first, if that's what you're looking for, or what the property you're trying to acquire is. Seek out all those opportunities first, and then come have a conversation with us.
I guess to build on that, I would say we very much like to collaborate with our borrowers. So we don't have standard term sheets that we provide. We really want to hear from our borrower, what is the situation that they're trying to solve and how can we be helpful? And within that, there are sort of broad strokes, as Shellon had shared, like CDFIs don't generally provide 30-year fully amortized mortgages. There's going to be a balloon payment at some point. We have interest rate ranges that we generally operate in. And so, there are some sort of norms in the industry, but we try to provide as much flexibility within that box as possible, and really are open to conversations. Another thing I would raise is I know that a lot of CLTs have the vision of converting to tenant ownership at some point, and I think it's a wonderful goal, but sometimes projects come to us with a lot more diligence needed into the viability of that. And so really trying to think about how we can help, or how your network can help to vet some of that. So, some things to think about are, are there lenders who are going to refinance our loan who are willing to provide a loan to a co-op or share loans to various tenants who are maybe sharing ownership. What kind of legal framework is the ownership going to take? Is it a fractional interest? Is it a co-op? Is it going to be like condominiums? And then also, what's the plan to make the tenants ready? I think a lot of times folks go in assuming tenants want this or will be ready. And sometimes they have different visions or different timeframes on which they're working for. And so, that doesn't necessarily mean the idea is off the table, but maybe working on a plan, again, with the lender about what resources, what training, what support can be provided to the residents to help ready them for that transition. Because if that is part of the plan to repay the CDFI, we're going to want to try to test the viability of that. And so readiness for the new buyers, i.e. the residents of the building, is part of understanding that journey of financing.
Thanks, everyone. Okay, and I'll also just supplement that with a little explanation. So like some of you may have heard about something called the Section 4 grant program that both LISC Bay Area and Enterprise administer. So it is confusing because Enterprise is both has a loan fund, and then I'm also at Enterprise, but I'm not on the loan fund, right? I'm on the programmatic side that handles Section 4, right? The programmatic side does give out capacity building grants for operations, but not for specific projects. And that's the same with LISC Bay Area. So you might have heard of like, they have grants available, but it's only for a very specific use. And it's, again, kind of like a different arm of the organization that's doing that kind of grant making. I'll also just like preface the rest of our conversation by saying we tried really hard to find someone to be on this panel who could represent philanthropy and talk about program-related investments. So if any of you are from that sector and feel comfortable answering questions about PRIs, program-related investments, we would love to hear from you. We know COCP, the Community Ownership for Community Power Fund, kind of it falls in that category. We also know that a lot of you already know about COCP, right? It's something we talk about every conference. So really glad to have you all in the room and everything. But just in terms of talking about other foundations and philanthropies that do this kind of project-related grant making or lending, we actually had a kind of a really hard time in finding who the right people would be to talk about that. And that kind of, I wonder if it's indicative, unfortunately, of the kind of absence of those sorts of resources right now. We tried, we really tried. Okay, one more question then. Again, I hope everyone has been holding on to their questions and has a bunch that they're ready to go with. But I'm curious to hear you all say, like, what, you talked about, Shellon, you mentioned, we're mostly bridge lenders as CDFIs, right? So that basically means it's going to be a short-term loan and then something else has to be available to pay back that initial loan, right? That's your quote unquote takeout strategy. So my question is, what allows you to say yes to a project with, a proposed takeout strategy? Like how firm does that takeout strategy need to be? And I'll maybe start with Eve.
Sure, thanks, Heather. So I think there are a couple of things, and you went over them on the slides. Is you might hear the term lenders say, "Does it pencil?" And that really means does this project generate, are you estimating that it's going to generate enough net operating income or NOI to support a loan? To say, typically we look for a minimum of 1.15 debt coverage ratio. Some lenders might have a 1.10. There's some flexibility. Sometimes we might have a program that it could go lower at 1.1 or 105, but I would say 1.15 is more typical. So that's the first thing. And then what sort of our credit folks, those are the people that we need to get to say yes, really focus on is how is that loan going to get repaid? And so it's not, ideal scenario, you'd have, a committed takeout source, or like the city, we're bridging for a couple of years until the city or state can get it together to actually give you the word that they committed to you, which we know has happened. But typically that you won't know that at the time that you're trying to buy the property you're looking at. But is this, and when we say, is this plan realistic, is we run different scenarios. So, you know, if we know different permanent loan programs that will come in and provide you like a 15, 20, 30-year loan, what do they need? What are their parameters? What are their underwriting guidelines? And so maybe look at that if it's like a Fannie or Freddie, if you're going that route, or if you have a relationship with a bank already and you've done commercial lending with them, is this something that they would be willing to lend on? So that's often like, and if it's a yes, then, or if it seems reasonable, then that makes it my job a lot easier to convince my credit officer to get the loan approved.
So I will say, as a mission-based lender, we really want to get to a yes. Sometimes in my head, I start with a yes because I get excited about what you guys are trying to do. And then I have to realize, well, there are many steps to yes, but we want to be at a yes. And in addition to what Eve mentioned, I think experience and capacity plays a big role. So you have a big idea, the numbers have to work, right? You have to be able to meet the debt service, LTV. You don't have a committed takeout source, but do you have experience getting there? And what I found nationally in doing this work is that that's oftentimes not the case with smaller emerging developers, which is part of kind of how we think about CLT. So I think you'd want to think about, do I have to hire for this experience, partner for this experience, or perhaps am I biting off more than I can chew on this particular project? And we are going to dig into who's on your board, who's your president. Do you have a development director that's going to be responsible for the project? Like, how are things really going to get from point A to point Z or Z, as I say? How do we get there? And who's taking you there? That becomes an important part in our conversations outside of the numbers.
I don't have much more to add, but I would encourage the partnership model. In Los Angeles, we've seen a lot of CLTs who are still young partner with experienced CDCs and affordable housing developers, and it's been a really great way to compensate for the learning journey that they're on and still be able to access, you know, substantial capital from both the public and private sectors. So I think it's a great way to build your chops to the point of independence in terms of operating and in your own portfolios.
I think there's a little bit of a preview to be made also, but there is a panel, I think, tomorrow morning on partnerships, and I think there'll be some in-depth discussion of how some of those partnerships works in LA. So, okay, with that, I'm going to start passing the mic around. If folks want to raise their hands and just feel free to ask away. Not all at once, though. Up front, okay.
Hello, my name is Franny from Chinatown CLT in Boston. Much like the California CLT network, we have a Greater Boston CLT network stewarding 300 plus permanently affordable units, as well as everything else, commercial, cultural spaces, farms, clean energy infrastructure, etc. One of our network's priorities is developing a $30 million CLT facility that blends philanthropic equity, CDFI debt, and public subsidy into this patient flexible capital that our members could tap into. From your perspective, what structures or covenants would make CDFIs most comfortable landing into a pooled facility like this? And what do you need to see from us to underwrite at scale? Thank you.
Yeah. No, by facility, are you trying to have a fund that then funds other CLTs? Oh, that's interesting.
Yeah.
I'm trying to already thinking structure in my head.
Yeah. So the word that comes to mind to me with fun is simplicity. Always try, and I know it's hard to achieve, but the simpler, the better. So we you know, Enterprise has worked, and we have a lot of existing like funds. We're in, various different types of acquisition funds where there's pooled, say, for example, in the state of California, there's the Golden State Acquisition Fund. Several of the CDFIs in the room maybe or are a part of it. But we have a chunk of money from the state that's blended with CDFI capital. And it's sort of like a participation model. Sometimes CDFIs participate with each other in a loan, where the state's money is 25% a loan and the CDFIs is 75%. And it's like one set of loan documents. But in sort of standing something up like that, there's I don't know, it can get complicated quickly, and then a lot of legal costs. You kind of want to know from the participants, like, what do they want? What do they need? Like, do they want to be in the, in sort of the positioning, like first loss? Are they comfortable with, like the philanthropy? Are they comfortable with potentially their money, if something isn't repaid, being kind of, lost first, or the most subordinate is also another way to say it. And then, yeah, I mean, I would say, like, again, just the simplest way is the best. If you're going to pool it rather than a structured fund, maybe, gosh, I don't know. I'm getting into the weeds here, but I'll just stick on trying to get understanding everybody's priorities, all the funding partners' priorities, and what they are comfortable with. And that will help you kind of structure that pool.
Yeah, I think what you're hearing is we have PTSD around funds. Like, there are lots of funds within the CDFI space. So your first step is probably talking to your CDFI partners, so you can hear some of, like, what Eve is saying, go simple. We've been a part of true funds like Capital F, it's an actual fund, and we've been a part of funds that are not really funds, but where we are counting on state and local funding to be like our first loss or take the riskiest piece of the pie. And I think we found when you have the common F fund where it's not a true stack and all that, it might be simpler. But for me, your first step's probably just talking to your CDFI partner and seeing how they maybe can be helpful, because you also want someone who has capacity to manage that fund, to underwrite the loans for that fund, because someone in that stack's going to want to be repaid, and you want to ensure that you're bringing the capacity to understand those projects to the table. And that's usually your CDFI partner who can do that for you.
Yes. So we have experience. We've been working with the COCP team on this very question for several months. And I think there's a few things in addition to what my panelists already shared. One, this sounds like it's a whole new scope of work that you're undertaking. You've been more of a borrower, developer, community organization. And so where does the expertise lie? Is that something you're building internally? Is it something you're going to acquire externally, or is it some hybrid of the in-between? Typically when investors or lenders to CDFIs or to funds provide capital, they're either going to look for a very substantial top loss, meaning who takes the risk. So maybe that's 20%, 10%, 20, 30% grants or equity that can absorb losses on any underlying loans that capital goes to. And if you don't have something like that, then they're probably going to require you to be that backstop. So you take on these loans. That's basically the CDFI model. We borrow money from banks and foundations, and we are 100% recourse to our CDFI. And so at our CDFI level, we have grants and net assets and equity that we've built up over time from surpluses or grants from the CDFI fund or other sources. And we basically have that kind of waterfall on our balance sheet. So you'll want to see that. And then another thing to consider is, who are you lending funds to through this fund, and what is the perceived risk of that, right? Because the investors will be considering the repayment risk of those underlying loans back to you so that you can pay them. And so it goes downstream. And so you'll want to be thinking about what are the products, what are the terms, what are the conditions and covenants associated with this. Everything we talked about earlier in Heather's presentation. What's the takeout for those sources to pay you back so you can pay them back?
Thanks so much, everyone. Oops. All right. Any next brave people who have a question, a burning question? Okay.
Hey, I'm Noah from California Farm Link. We're a CDFI that lends to agriculture in California. And I am curious from your experience if there are any particular types of projects or capital needs that your normal funding sources can't go towards. Like if you have any niche needs for like smaller flexible capital sources, we're on the lookout for stuff like that. So I'm curious if there's like categorically stuff that comes up for you.
We only do housing, so that's like the bottom line of that, and we are bridge lenders. So what we oftentimes struggle with is having capital that can go out longer term, so 10, 15, 20-year loans, and that's something that people come to me a lot for, like, I need permanent debt, and we just don't, because of where we get our funding from. Oftentimes we're borrowing on short term, so we have to have asset and liabilities that match. It prevents us from being able to do that. We do smaller loans at NHT, so we've done $200,000-$300,000 loans. So that's not something I can point to as one of those things, but I know for other CDFIs, sometimes the loan size is too small on a project and they may want a different partner who does smaller loans to work on it.
I would say consumer lending. I don't know if that's something you're able to do, but that we often see a big, we just suddenly stop, right? And the conversion of multifamily from a CLT to the tenants is a good example of that, where you enter in a whole different regulatory environment, and so we're not able to do that. So we often partner with like credit unions and folks like that to help solve that. That gap. But I think that's an area that, especially in this space, will become a growing area of need for capital, I suppose.
Yeah, I would say that enterprise is mostly real estate based. So what I would say, we've sort of fundraised for a limited amount of, say, lines of credit, organizational level lines of credit, but we really don't have, we're often like, lending on a piece of land or a property or what have you. And we do housing and communities facilities, but sort of that more line of credit that can work, sort of, that is more flexible in what it's used for, is an area that we, that's harder for us to lend on, but it is a need that I've seen. So
one other thing that came to mind. So Heather mentioned we are typically doing like 80%, maybe 90% LTV. There are times when that additional 10 or 20% is difficult for a developer to find, and someone who's willing to do that piece along with them. We have done it on like larger deals for very established developers. We've provided parts of their equity, but that's also a good space to play in, right? Because it's a smaller amount than like a super large loan.
Unsecured, that's what I say, unsecured. Yeah, if you got that, great. Yeah, happy to partner.
And I think this is where you're going with this, Steve, but just some of the pre-development costs are like what we see, especially emerging organizations, really struggling with, because it's like if you only have $50,000, but you need to spend all of that to do your initial due diligence, and then you realize that there's a problem with that property, but you don't have another $50,000 to go after a different one, like then you need, like, just emerging organizations really need that capital in a way that larger organizations, more established organizations are, maybe they just can go and find another one and they don't have to worry about having lost all that money. I'm seeing, okay, I know we have 1, 2, 3, and 4. So thank you for everyone's getting queued up.
I really don't need mine.
Okay.
Yeah. Randy Solar Mechanics Bank, we have a pretty significant requirement under our CIG agreement to put pretty meaningful amount of money to work in community land trust specific targeted investments. We don't have the resources, I don't have the resources to underwrite individual home deals or smaller deals. What's the best and easiest way, the most credit-worthy way for me to put $10 to $20 billion to work? Can I be a side-by-side co-investor with a CDFI? And I don't want to do an EQ2, VC debt.
You can do that to a CDFI. I mean,
Right.
we're borrowing from banks all the time. I don't know if you want to do side by side. What I found with side by side is you still want to underwrite the way you underwrite, and then we kind of are.
We want to delegate the underwriting to you. We want to give you
Lend us the money.
delegate to you, and
At super low rates, lend us the money. Tom, I'm sure you do.
And how do I assess relative value of the different CDFIs in terms of their portfolios of community land trust investments, and it has to be specifically targeted to community land trusts under our CIG.
Yeah. You can look at our. I'm happy to do so. One of our claim to fame at NHT is that we lend to probably the most CLTs in the country, and we've done some pretty nice things. So we've partnered with GSN, who Alex is in the room, on ensuring that the CLTs have technical assistance so that they're ready for our debt. So we've done a few things. We've partnered with Amazon, working with CLTs. So I'm happy to talk more. Yeah. Just let's say it's a good thing if he lends us money to lend you money. So that's like
Yeah, I think what he was saying is that he has sort of a directive, this pot of money, which is not common to lend directly to CLTs, but doesn't have the staff on board to actually underwrite the individual loans to projects. But, you know, a CDFI like NHT does. And so if Mechanics Banks lent to NHT, then they can get the money out, and it's a win-win. So.
And this little vignette is exactly how CDFIs are capitalized. We get money from banks. Sometimes there's very specific lanes they want you to stay in for a community impact agreement or something. And other times it's just, we like what you do and here's money to keep doing it. And so we get that from banks all across the country and regionally, foundations, the federal government, that helps source that. And so we basically, like the fund example here, we're doing that within our own balance sheet and making these loans.
But one thing I'll add to that is oftentimes that's not free money. It's like, you know, lower rate percentage, which is why we can't lend 0%, or even 2-3%, because we use that spread in between what we get from banks and what we lend out to CLTs and to projects to cover our costs, to pay for our staff and keep the lights on and things like that.
And I'll pass it to the gentleman in blue in just a second, but just thank you to the gentleman from Mechanics Bank for introducing yourself and your organization. I think that's really helpful context for everyone to have as we're going through these questions. Would you like the microphone?
I think I'll be all right.
Okay.
Thank you. And the reason I'm like, this may be related indirectly to that, but much more on the non-clinical side. So my name is Shellon.
So, you know, it's helpful for people on Zoom.
Yeah.
Like, and it's also helpful for the interpreter.
Thank you. Got it. Yeah.
Hi, may be directly related, may not. This is a non-technical side of it. You already prefaced by saying this wasn't the topic you were going to cover, but I have to ask anyway. I am the executive director for the Central California Land Trust, and we are starting to plan community engagement, housing, education type clinics. And we have acquisitions, and we are looking to figure out what are the consumer loan vehicles that are available so that we can get that consumer education piece started, and that there are viable loan resources for, so single family homes, land leases, improvements separated with affordability indexes in perpetuity, 55 years, generally speaking.
And I'm going to just keep using the mic because I'm realizing in the back of the room, there's a lot of background noise. So it's actually quite hard for people to hear back there without the mic.
I think, you know, there's a lot of TA providers that help help folks get ready for ownership. Now, I know in this space, there's a much wider range of the umbrella of ownership, and not every TA provider can provide that, but neighborhood housing services is one of the nation's biggest in terms of providing both mortgages and buyer readiness. They have home buyer education. Sometimes Habitat for Humanity chapters will do that. Sometimes they limit it to just their products, but there might be some opportunities for partnership there. And then I think in terms of loan products, many banks have access to different options for down payment assistance. For example, if they're a member of the Federal Home Loan Bank, which many local and regional banks are, they can apply for grants and things to help with people's down payment assistance. And also maybe some of the localities in your area might have contracts to local service providers. If they have down payment assistance or other homeownership programs, they probably have a network of buyer-ready training programs that you might be able to leverage as well.
I can just add to that. Ooh, sorry, everyone. Just add to that one. And we were having some lunch conversations actually that were like pretty much right on this topic. So shout out to Felix from Oak CLT, who has investigated share loans pretty extensively. And we have had a problem in California of not having a lot of share loan lenders, or hardly any. And so I think that Felix seems like they're really leading the charge on trying to get lenders who are working in other states and have these products in other states, but bringing them to California, because that is have been a barrier for these transitions to limited equity co-op models. Yeah.
This isn't.
Okay, sorry.
Single family residence.
Yeah. One more shout out is to Self-Help Credit Union. We've done a lot of work with them. Sounds like you have too by the nod, but they're working with us to develop a tenant in common loan product, a fractional interest on some pilot projects that we have. But they have a very robust consumer lending market and very mission aligned with the work we all do.
Great. I think we had a couple of questions at this table. Did you have a question also? Yes, okay.
So many, I was trying to choose. Okay, so people come to you and they're like, I have this idea. And you're like, that's great. Let's break it down. Okay, so what about the people who are, okay, once you get to that established point, you either you've partnered or you've done, okay. And then there's this sort of like, this is my first one, and you're doing a lot of great education work. What about like the third, the fourth? Because I feel like they've got a model going, it's working, but like every time they have to raise money for, it's like the same damn thing. So that piece, I feel like I'm just so curious, like how, and maybe it's a fund, which is how like private real estate developers are like, instead of raising for each deal, we're gonna raise for the next 5 deals and make a fund or whatever. But like, then you're a fund manager in the SEC, whatever. So I guess I'm just like, what are your solutions for the sort of like, the model's working, we've proven it a few times, but like, if they have to fundraise 400,000, $1 million, like 5 times each time, it's not working. Or I don't know, I'm curious about that mid solution there.
You ready?
If I'm understanding you correctly, I don't have an answer for how they stop fundraising, because this work really does require subsidy, because we are solving for an issue of income, right? That is largely what we're solving for. People don't have enough income to pay rent or mortgages, so you have to subsidize that. I think you just get more efficient perhaps as you continue to do it, but there's no quick fix on not having to get free money. With the CDFI on our side, the more you've done, the better it is for you working with us. So when you come on the 3rd or 4th, we know you have a track record. You've done this before, you have the experience. So the questions will get a little bit easier. The underwriting will get a little bit smoother and faster. But I can't solve for the issue of income, which requires you to fundraise.
somewhat along your lines, I think. I think CLT, certainly developers do this, think about their portfolio, and you build a big enough portfolio, and then you finance the whole portfolio, right, in bulk. And over time, you can maybe pull equity out of that portfolio. That now helps you buy your fifth or sixth or seventh building. I think this is a very market mentality. It's how a lot of people get into real estate development. But I think there are lessons there that mission-aligned developers and CLTs could actually try to mimic when they get to that point. But I think it's a way that you can sort of pull some of the value out of your portfolio to sustain yourself so that you aren't in that kind of rat race of always having to fundraise. Now, it's going to be different for everybody. It's going to depend on the underlying economics of each project. I think, something that we've sort of floated with partners is even buying what you might call market rate housing today and owning it, because in 10 and 15 and 20 years, that's going to be, when we talk about NOAA properties, they were market rate properties at one point in time. And if you do go up that income ladder a little bit, you're tapping into conventional financing. You don't have as much subsidy. Now that's an ideological position. I'm not saying everybody is ready for that, but there are tools, I think, that are at our disposal to make capital raising easier, to tap sources we have typically been excluded from, and maybe holistically, like a combination of all these things creates a healthier, more financially self-sustaining portfolio that helps overcome some of the constant fundraising challenges.
Yeah, and just on Shellon's point also, I think like the, acquisition funding piece, like this is why, thank you. This is why things like the Community Anti-Displacement Preservation Program that is potentially going to be in the state bonds next year is so important, right? Like that's a big chunk of money. The entire idea is that if we just have these big chunks of money from the state, we won't have to keep figuring out where all this, figuring out how to make it work over and over again, reinventing the wheel. One question back here, if you can let us know your organization and your name.
Hi, I'm Ada Kim with Beverly Vermont Community Land Trust in Los Angeles. I guess my question is around, a lot of the CLTs, I think, are considering capital campaigns as part of sort of, their funding stack. I guess I'm wondering, what would make, I guess, the capital campaign seem more feasible? Like, what would you like to see? I think, there's a mixed bag about like how, I don't know, you tell me, like, how would you consider a capital campaign, but also what would make it seem more like realistic?
Anyone who wants to.
From a lending perspective, if you're saying like this capital campaign is going to be our equity, is going to come in and, finance this, 20-30% of the building or of this acquisition, we will like the question, the top one that comes to my mind is how real are those pledges? And that's a tough one because I know tax reasons and whatever, people don't want to, you can't like put in writing, like I'm going to pledge you this much. I mean, if it's within the tax year, I don't know. I'm no tax attorney, so don't quote me there. But like, if there's something that you can say, like this person is pledging this much, and there's like evidence of it, that makes it more real. Shellon was saying too, your experience, like, have you done this before and were you able to raise X amount of money? That's another thing that will give us a little bit more comfort and be, able to get to yes type of thing. But it is, capital campaigns, are a little bit more challenging, but that is something that we have bridged, those, it's just a matter of, what can you get to make us know that it's a real thing coming in.
So is it individual donors? Is it foundation? Is it city? Like what's wrapped up in that capital campaign?
Who are individual donors.
Yeah, so everything you said then.
Yeah, that can be the hardest one to consider for takeout or refinance if that's what you're considering using this for, that a loan bridges to that so you can act now. I'm assuming is kind of where your question is coming from. But one thing might be, could you, let's say you have a 3-year plan to fundraise, to raise a few $100,000 to pay down a bridge loan. Could you maybe work with a lender that could lend you for 10 years and so as a contingency plan, you can pay down enough of the loan and get to a loan to value or a debt service coverage or whatever you need to exit to a refinance. And it maybe gives you, the lender's not underwriting to the campaign, but it gives you runway to then prove you could do it. So now you have a track record when you try to do it again. So you might be able to work with, debt financing in a more flexible and maybe a little bit of a one-off, but it helps you build your track record, right? It sounds like without that, you can't try it at all. And so there might be some ways that you could do that.
One other thing. So we worked with a CLT in East New York, and they did a capital campaign, but they did that first. So I think if you can do that and have that funds and then come to us, if it's your first time, then you have a track record, right? You're like, I did crowdsourcing and I got $1 million, and that's pretty impressive. And that's what they did on that one. And then they came to us and said, this is our equity. We already have it. Now, could you help us with the remainder of the funds? Thank you.
Thank you. Hey, everybody. I'm Jared Russell, the Executive Director of the Community Land Trust Association of West Marin, also a member of the West Marin Housing Collaborative, along with Hal from Two Valleys Community Land Trust. There's a lot of pressure on the West Marin affordable housing community right now. We have a lot of ranch displacements, ranch workers, about 40 families, and there's also, all of us, I think, are kind of reorienting after BAFA didn't come through. I feel like there's like an ecosystem sort of reshuffle in the works. Yeah, it was yeah, you want to say that one?
Okay.
Yeah.
Sorry.
It's $20 billion.
Yeah. So BAFA was the Bay Area Housing Finance Authorities. It was going to be an initiative with $20 billion for the 9-county Bay Area. And unfortunately, that measure had to be pulled for various reasons. But there was preservation funding that was included, to be included in there that everyone was sort of counting on.
Yeah. And so I think structurally, we would all acknowledge that there just needs to be more impact. Like most communities are so behind on affordable housing. And so we're sitting wondering, how do we scale faster? I mean, CLAM is the acronym for our land trust, and we've been around for like 20 years, and we're working on a big LIHTC deal. We're doing basically like a portfolio for, we're trying to do more properties in the next 12 months than we've done in 20 years. And now the fund approach that I've been hearing a couple folks mention is working really well with funders, like with individual funders in particular and the foundations. And I'm just still wondering, like, it's starting to feel like that's a key ingredient to growing faster, but I don't know how to map it into that programmatic growth that we're all looking for going forward. Like, there's a crisis right now and we have to sprint to do it, but I'm also like, why can't we do this over a broader period of time? And so, local foundation partners used to do 10 to 15-year loans at, 3%, 4%. We got spoiled with that. And that's kind of, I think they're shifting to a 5-year sort of bridge model too. I've heard talk of housing bonds where, like, you had the below market rate program, right, Hal? That was 2%. But I guess my question would be, what are the creative things that you're seeing that are actually working? Or are there certain communities or counties where they have a housing bond and this all becomes much easier? And also, if you could just, in the next 5 years, rally us to change something structurally, what would it be? Because it feels like something's broken. Commercial rates, 7-8% don't work for affordable housing unless we burn our donors out on the front end.
Do you want to start first and I can jump on that? Okay. So I've been requested to field this one actually. So I'm not a lender, but one of the things is, I mean, do you know about the Oakland ACA program that, okay. So the city of Oakland voters approved a bond measure a few years back, and it seems like they are in the very close to actually getting to lending in that program. So I believe there's other counties that are considering bond measures. You know, the advantage of that being, you know, you have a pretty big chunk of change. The disadvantage being it's for a very fixed period. So it's like basically until the funds run out, you know, and then you have to go back to voters again, right? And then it's like, so you maybe have 4 or 5 years of money available, and then you're kind of back to square one. So I, you know, kind of like agree that there's something that is broken. We just like don't have those permanent and recurring sources right now. That they, I would like, you know, maybe keep an eye on like what continues happening in Oakland in the coming years. Yeah.
Yeah, we have something similar in Los Angeles. There's a county level bond, or a sales tax, I guess is how it's funded, for a range of services and housing development. We also have a local city level fee on real estate transactions. And so I think there's a variety of tools out there, and like trying to balance those to like, right, you want the development to keep happening to generate the revenue. So it's sort of like striking that balance that, you know, isn't a disincentive, but creates the ongoing and predictable revenue stream that an ecosystem needs to sustain itself.
DC has a housing production trust fund, which is raised from deemed recordation taxes. The problem became like that was supposed to be the gift that keeps on giving, but the real estate market is still dependent on the real estate market. So with nothing happening there, that's been in question, but it's been funded at a level of 100 million for the past, I'd say like 10 years or so. And that's filled a lot of gaps in light tech projects. And that's what we look to with our project.
And just if you, Heather mentioned Oakland's program, it's acquisition and conversion to affordable housing, so ACAH. Yeah.
Yeah, I think the political context also in whatever jurisdiction you're working in is also critical, because Oakland, Alameda County voters have been very, very giving, right? Like very likely to approve measures. In other counties, you know, we know that there's like averseness, and we have in California this very high voter threshold of 2/3 in order to pass a funding measure, unless it is a citizens initiative. All right, we have, okay, there's one question here, and then I think I'd seen Ian first, so I'll walk around.
Ian Winters, Northern California Land Trust. So my question is kind of coming out of, we've run our own down payment assistance program for kind of single family and condo CLT projects for a very long time. And in the last year or so, we've had a bunch of pretty interesting conversations with family office type donors who have helped fund some of our incubation projects in smaller dollar amounts, but about, well, what are our buyers doing for first mortgages? And, you know, they work with all the normal lenders that first mortgage CLTs do, but at 6.5%, that's a huge hit to the project, as we all know. So their offer and kind of discussion is, do you have an entity that we could work with that can do single family first mortgages cost effectively, and the family office could provide the capital for that at a meaningfully below market rate interest rate, but obviously not free money. They want to basically do the first mortgages, but is there a friendly contract loan servicer or a way to do this, or a way to say funnel it through a CDFI that then contracts with like a guild or some other, you know, a stereotypical first mortgage lender to actually do the servicing and underwriting? Because we also don't want to be the first mortgage lender. We're clear on that. We're second mortgage lenders, and we don't want to be the first mortgage lender.
similar to my comment earlier, a group like a neighborhood housing services, or maybe even your local jurisdiction, if they have a home lending program of their own, they might be able to run a debt product through it. You will have to think through, like, this entity will need to have the right licenses and certifications to provide consumer level finance and to secure these loans on their primary residence and all of those rules. So I would try to think about your neighborhood housing services, maybe Habitat, maybe your local city or county, self-help credit union, which is just like we've been saying, they're a CDFI. They could take a $10 million family office investment and then roll it out into individual mortgages. So I think there's a range of folks that basically provide mortgages now and are looking for cheap capital to do that, and could pair up with your particular buyers.
Hi, everybody. I'm Nazir with the Long Beach CLT, and I know folks have been talking a lot about like experience and like making the case for experience, and like using full portfolios, for example, as like backing for additional loans. And I'm wondering kind of if there's anything to what CLTs are really good at is like forming coalitions and like networks and stuff. And is there anything to like coalition-wide experience or like coalition-based portfolios? I mean, we have like agreements, for example, in our coalitions. I know with board member experience, for example, there's like a legal requirement to the organization, but we do have agreements, like formal agreements between coalitions and stuff. Is there anything there that can lend to like that experience, those experience requirements? And also, I don't know, I'm just curious if there's something there and like things that you've seen kind of work out.
So if your organization itself doesn't have the experience, but somebody in your organization has sort of developed or worked on acquisitions before, we will look to individual capacity, or if you don't have it, there's ways like you could work with a consultant. I mean, we want for, obviously you to build the capacity on your own staff, but for that maybe first one, we would highly encourage you to work with somebody who's done it before. And so that's one way. If you have the people that are working on this particular project that have that experience, that is maybe sometimes a way to get around or to work with sort of this experience requirement. Amen.
I actually think there's a lot there. So joint venture partnerships, we see that stuff all the time in the development world. And I would encourage that if you across a network are trying to build, think of all of the aspects that are needed and maybe creating some joint ventureships with others on the acquisition side. And then I've seen on the operating side so that you can maximize efficiencies as well. There's New York had this, it's called the JOE, it's a joint ownership entity, I think is what it stands for. And they were managing a ton of units out of this one entity and were able to share property management and really efficiently manage because they were doing that instead of like, I have a 5-unit here and you have a 6-unit. Well, we now have 11 units in one entity. So I would encourage that. So it's like you're borrowing from each other, and JVs are something, joint ventures are something that we understand and work with all the time.
Another area that I think a lot of California groups could be thinking about is most of the land of SB this and SB that. Most development now has to put some units aside as affordable. And many of those developers either struggle to fill them, don't want to deal with those tenants. And so these are happening anywhere you see development. And we know there's plenty of communities in California that try to avoid development, but anywhere that has development is probably going to have some of these units. And there could be an interesting way where CLTs help to manage those, to fill them, to provide services as an organizer, to your point, having that coalitional experience and bringing that to this, and maybe finding allies and partners in strange places. And you could build a portfolio from a management side that could maybe build some experience to eventually own your own or borrow money without ever having to borrow a dime. And there is an inventory there that could be an interesting place for CLTs to play. They're already reserved for lower income residents. And what we've seen is like sometimes landlords, it's easier when the rents are really low, sometimes landlords will just keep them empty because the operating expenses aren't even covered by the rent. So why bother? Why, from a selfish perspective. So there could be ways to add value to those folks, serve your community, and really build a real estate experience without having to borrow money up front in the first place.
Just to add on to what our panelists have kind of collectively touched on. So the joint venture partnerships is something that folks might be familiar with, but the California CLT network with, I think, Land and Liberty Consulting a few years back did a whole report on JV partnerships. So definitely encourage folks to look at that. That covers some of the different models for doing JVs. And then I think also just like development services contracts between CLTs are something we've seen more recently, especially with San Francisco Community Land Trust. They're both doing some development services and then also sort of providing through the capacity collaborative, their CCC, just making some of their knowledge more broadly available. But in terms of like what lenders will consider to be relevant experience, my understanding, and you can let me know if I'm off base here, is that like having a contract is probably like there needs to be like we will contract with this person, not necessarily like the coalition kind of collectively has this knowledge, unfortunately, which is, I think we know that like a lot of the collaboration is really happening and it's really real, but I think it's hard to make that case if there's nothing actually written down. We have maybe time for one or so more questions. I think we're getting close to 5 o'clock. So anyone want to be brave and put up okay, Matt, I saw your hand.
So I'm hearing and I've heard a lot about how the industry is reluctant to support CLT models because of risk or unfamiliarity with the model, and appreciate that there are CDFIs and other folks who are taking that risk and getting experience. So my question is, what can be done, or what are you all doing to help normalize and move the industry to become more aware and more comfortable, to help folks understand that what the risks are and that they are not insurmountable, and that we can expand the landscape of financing for CLT work?
I think I'm first jump at that.
So I'm kind of a firm believer of like show by doing. And so all of us have lent to CLTs. We have probably 8 to 10 loans to CLTs in our portfolio. We are working to try to help stand up a fund to bring more investment capital into it. We've helped philanthropy to try to provide seed grants to the $50,000 due diligence example to help seed investments and build some experience that way. We've also helped to inform as many of the folks talking today, your local governments and those programs, helping influence how those programs work, as well as helping to bring that capital to bear. Similarly with philanthropy, we do a lot of that work. And then just a lot of, as I think all of us have said, we do, give us a call and talk through it. There's sort of like a lot of free TA built into CDFIs, especially those willing to work in this space, and really try to be collaborative. And so I think in all those ways, we're trying to show the sector that not only are we lending, but here's some ways to do it. Here's some ways to scale it up. And I think over time, and many of us have loans that are first generation loans that haven't matured yet. And so I think like the next few years are going to be very telling. And so we continue to work closely with our borrowers and really try to help plan for that transition so that it shows that these truly can be debt investments that can repay, and we can recycle and do it over and over and over again.
I got here at 1:30 a.m. this morning from DC. So I think flying across the country to be here with you is part of what we're doing. We also made the SB 1079 loan that started the FIP conversation. So NHT is always a willing partner. I do have a few loans in California to CLTs. Yesterday, got approval for a loan to Liberty CLT. So we are always trying to do the work. And there was a what makes us different question I was going to be asked. We have lent for smaller projects. The SB 1079 project we did, I think it was 1 unit. So we have lent for smaller projects. I'm not afraid to do that. I haven't been getting many calls from my California folks, which is part of why I wanted to be here. We're always happy to have conversations, and don't think of the CLT industry as riskier. We lend to CLTs throughout the country. We have an initiative with Amazon in DC, Nashville, and Puget Sound to provide loans mainly to CLTs that are doing this work. We are partnered with GSN on that. We're partnered with GSN through a Robert Wood Johnson Foundation initiative to provide enterprise level loans. So we've provided 4 of those, I believe, Alex, to 4 CLTs, none in California, but Alex is waving, to CLTs throughout the country to help them scale. So we've, I think, in a way, doubled down on our CLT lending and are very much interested in how we can be helpful within the California space to make that more of a reality.
Yeah, I'd echo what I think Shellon and Tom are probably doing a little bit more than we've done at Enterprise, but I'm like just trying to find ways that I can support CLTs. I'm talking to the folks at CLAM, see if we can get them acquisition financing for all these properties you're acquiring soon. And remember that I think all 3 of our organizations too are going to be part of FIP. Sadly, that did not come through, but our policy folks, I think, keep on persevering, trying to push for more state level funding for preservation. That's, Heather's out there day in, day out, trying to get us more resources. So I do think it's not easy, but we're not going anywhere. And I think the more we do, and as Tom was saying, like some of the loans that we've made that are longer term, they're still out there. So, we're hoping to see what happens with them. And then once they get repaid, we can get that money back out. So not to say that we're not doing it now, but that also helps. So yeah, we're doing what we can.
So everyone pay back your loans. All right, we are at 5 o'clock. Thank you all so much for attending. Thank you so much to our panelists. Really grateful for you.